Hey everyone, and welcome back to all you incredible moneymakers out there here on Lion of Crypto. Let's dive straight into the XRP action, because there is a lot quietly brewing right now that could end up changing the landscape for holders who are paying attention. Picture this for a moment. It's the week before Christmas 2025. Markets are calm, almost eerily so, like a holiday dinner after everyone's already eaten. XRP is hovering around the 188 to 190 range, down slightly on the day. Bitcoin is holding near 88,000, and Ethereum remains capped below that psychologically important 3,000 level. Across the board, the crypto market feels sleepy heading into the holidays. Traders are logging off, institutions are closing their books, families are gathering, and trading volume is thinning out in a big way. But this is where things get interesting. Periods of low volatility like this have a long history of setting the stage for sharp, sudden moves. Algorithms don't celebrate holidays, and they don't take time off. All it takes is one unexpected catalyst to light the fuse. We've got delayed GDP numbers scheduled to drop, initial jobless claims coming midweek, and any one of those data points could be enough to jolt price action. Layer on top of that the ever-present risk of geopolitical headlines or a single comment from a world leader, and suddenly a quiet market can turn volatile fast. In thin conditions, even small news can have an outsized impact, pushing prices sharply higher before snapping back or triggering quick downside moves just as easily. That's why these calm periods tend to reward those who stay alert. Opportunities often hide when the market feels boring. One development that's flying under the radar right now, but could be genuinely game-changing, is happening on the regulatory front in the United States. Bipartisan lawmakers in the House have drafted what's being called the Digital Asset Parity Act. The proposal would exempt capital gains taxes on regulated stablecoin transactions under $200 starting next year. The idea is simple but powerful. Dollar-pegged stablecoins used for everyday payments would be treated more like cash, removing the tax headache that currently discourages real-world usage. From a policy perspective, it makes sense. Stablecoin issuers often hold large amounts of U.S. treasuries, which indirectly supports government financing while encouraging innovation and adoption. Critics point to potential loopholes, like splitting large transfers into smaller ones, but in practice, gas fees and friction on most blockchains make that kind of behavior inefficient. If this proposal gains traction, it could significantly boost stablecoin utility, drawing in more mainstream users. And while XRP itself isn't a stablecoin, increased on-chain payment activity tends to lift efficient settlement networks across the crypto market. Assets designed for fast, low-cost transfers stand to benefit from higher transaction flows and improving market sentiment. Speaking of adoption-driven catalysts, XRP spot ETFs have now been live for several weeks, and the liquidity story around them is starting to get more attention. In a recent interview clip making the rounds, Bitwise CIO Matt Hogan explained how rising ETF volumes directly enhance underlying XRP liquidity. More trading leads to more visibility, which in turn attracts even more participation. He also addressed a common misconception, pointing out that ETF exposure often acts as a gateway rather than a substitute. Many investors start with ETF shares and eventually move into holding actual XRP in wallets, expanding the ecosystem over time. This is especially important when you consider the trillions of dollars sitting in retirement accounts like 401ks and IRAs that can't easily go on-chain due to penalties or restrictions. ETFs provide a compliant bridge for that capital. We've already seen this pattern play out with Bitcoin and Ethereum ETFs. Initial price weakness following launches, followed by powerful rallies as inflows quietly built. Ethereum, for example, dropped sharply after its ETF debut before going on to rally more than 250% in the months that followed. XRP's timing has been less forgiving, launching into a broader market pullback, but similar pressure is being felt across every major crypto ETF right now. This isn't an XRP-specific issue, it's part of broader cycle dynamics. The silver lining is that inflows are building under the surface, setting up the same liquidity flywheel Hogan described, and as we zoom out to the bigger picture for altcoins, including XRP, the technical backdrop begins to tell a much deeper story as analysts start to point out how historically oversold conditions against Bitcoin are beginning to line up with early signals that something much larger may be developing beneath the surface, especially as we approach the turn of the year and the conversation starts shifting toward early 2026, especially as we approach the turn of the year and attention slowly shifts toward how 2026 could unfold for the broader crypto market. When you zoom out, it's clear that altcoins like XRP have been lagging Bitcoin for an extended period, and that frustration is very real across the space. But from a technical perspective, this underperformance is exactly what has pushed many altcoin pairs versus Bitcoin into historically oversold territory. Analysts have been highlighting that after nearly 4 years of relative downtrend, momentum indicators like RSI are sitting at levels rarely seen outside of major cycle bottoms. There have been a couple of false starts over the past few years, brief rallies that faded quickly, but now some longer-term indicators are beginning to converge. The MACD on several altcoin to Bitcoin charts is flirting with a bullish crossover for the first time in more than 3 years, a setup that closely resembles conditions seen ahead of the 2021 altcoin run. When you combine that with expectations for easing financial conditions, lower inflation, and a potential shift by the Federal Reserve toward more accommodative policy in 2026, the historical pattern becomes hard to ignore. In previous cycles, once liquidity starts flowing back into the system, altcoins have tended to outperform Bitcoin by a wide margin. Of course, not everyone is leaning fully into that bullish narrative, and this is where the debate becomes important. Recently, leaked research notes from Fundstrat stirred up a wave of fear, uncertainty, and doubt. Screenshots from their internal discussions showed their head of digital assets, Shaw Farrell, preparing for a challenging first half of 2026. His base case outlined scenarios where Bitcoin could revisit the 60 to 65,000 range, Ethereum could dip toward 1,800 to 2,000, and other major assets could see meaningful pullbacks from recent highs. The risks he highlighted included potential government shutdowns, tariff uncertainty, volatility in bond markets, and the possibility of tax loss selling clustered around ETF cost bases. In response to those risks, Farrell reportedly reduced a portion of Fundstrat's crypto exposure, moving capital into cash as a defensive measure. But it's critical to understand that this is only one side of the conversation. Fundstrat isn't a monolith, and other voices within the firm hold very different views. Tom Lee, long known for his macro optimism and now chairman of BitMine, has been pushing back against the more cautious stance. He's been accelerating Bitcoin purchases, arguing that the traditional 4-year cycle is evolving. According to Lee, ETFs, corporate treasury allocations, and even early sovereign adoption are changing market structure in ways that make short-term volatility less important. From his perspective, structural lows are likely already in, and while choppy price action could persist, new highs into early 2026 remain firmly on the table. Technical analyst Mark Newton adds another layer of nuance, suggesting that while damage from earlier drawdowns still needs repair, a bounce into February could lay the groundwork for stronger rallies later in the year once trends stabilize. What this apparent contradiction really highlights is how serious research operates. Large funds manage risk across multiple time horizons. Short-term defense and long-term conviction aren't mutually exclusive, they coexist. This same dynamic is playing out in XRP specifically. Despite the recent pullback toward the 1.88 to 1.90 zone, on-chain data and ETF flows tell a very different story than the spot price alone. Whale activity remains elevated, and exchange balances continue to trend lower, suggesting accumulation rather than distribution. Quietly, institutions appear to be locking up supply, while retail attention drifts elsewhere. That's a familiar pattern from previous cycles. Early ETF phases often look underwhelming on the chart, but beneath the surface, demand builds a foundation that can later amplify price moves once momentum returns. Thin holiday liquidity only adds to the illusion of stagnation. Big players tend to use these quieter periods to position, not to chase headlines. Recent data shows spot XRP ETFs have accumulated significant net inflows since launch, with consistent positive days even as parts of the broader crypto market have experienced outflows. That kind of steady demand reduces available float and can magnify future price action when sentiment shifts. We've seen this movie before with other assets. It rarely feels exciting at the time, but it often matters in hindsight. As we move through the final stretch of the year, upcoming economic releases like GDP revisions or jobless claims could create short-term volatility, but the bigger forces remain structural. Regulatory clarity, maturing ETF products, and real-world payment utility continue to improve. For XRP, the combination of oversold technicals, growing institutional footprints, and expanding use cases paints a picture that's far more constructive than current price action might suggest. Markets have a habit of rewarding patience, especially when narratives are quiet and conviction is being tested, which is exactly the kind of environment we find ourselves in right now as attention slowly turns toward what the next phase of this cycle could bring. As attention continues to drift toward the next phase of the cycle and how early 2026 might shape up. One of the most telling signs right now is how disconnected XRP's fundamentals appear from its spot price. While price action has been range-bound and uninspiring for many, the underlying data keeps pointing in the opposite direction. Institutional behavior, on-chain metrics, and ETF flows suggest that this consolidation phase is less about weakness and more about absorption. Reduced exchange balances indicate that XRP is being moved off trading platforms and into longer-term custody, a pattern that historically aligns with accumulation rather than panic selling. This quiet buildup is happening while much of the retail market remains disengaged due to holiday distractions and fatigue after a volatile year. That disconnect often creates the conditions for sharp repricing once liquidity returns and narratives shift. XRP ETFs, in particular, have been a standout. Since their November launches, cumulative net inflows have surpassed the $1 billion mark, with some reports placing assets under management even higher. What's especially notable is the consistency. These products have recorded positive inflows day after day, even during periods when Bitcoin and Ethereum ETFs have experienced intermittent outflows. That kind of steady demand reflects disciplined institutional positioning, not short-term speculation. When large amounts of XRP are locked away in ETF custody, the available supply on exchanges tightens. That doesn't guarantee immediate upside, but it does change the market structure. With a smaller liquid float, any future surge in demand can have a more pronounced impact on price action. This is why early ETF phases often look dull on charts. The real effect shows up later, once momentum flips and sidelined capital re-enters the market. We've seen that exact sequence play out before, and it's one reason seasoned participants pay close attention during periods like this. On the policy side, the renewed discussion around the Digital Asset Parity Act adds another layer to the longer-term thesis. By proposing to exempt capital gains taxes on regulated stablecoin transactions under $200, lawmakers are signaling a more practical approach to digital asset usage. Treating compliant stablecoins more like cash for everyday spending removes friction that has long held back real-world adoption. Because stablecoin issuers typically hold large reserves of U.S. treasuries, this framework aligns incentives for both regulators and the private sector. If this progresses into 2026, it could meaningfully increase on-chain transaction volume. Higher transaction activity tends to benefit networks built for speed and efficiency. XRP's role in cross-border settlements and payment infrastructure places it in a favorable position if stablecoin usage expands. Small regulatory steps like this often snowball over time, gradually shifting market sentiment from speculation toward utility-driven demand. That shift doesn't always show up immediately in price, but it reshapes the narrative that ultimately drives capital allocation decisions. Zooming back out to the broader altcoin landscape, the feeling of stagnation is understandable. Bitcoin dominance has remained elevated, and many altcoins have underperformed for what feels like an eternity. Yet, when you look at the data, altcoin to Bitcoin ratios are sitting at extremes not seen since previous cycle lows. Momentum indicators continue to flash oversold conditions, and historically, these periods have preceded phases of strong relative performance once liquidity conditions improve. Altcoins often lag Bitcoin's initial move, then catch up aggressively as investors rotate in search of higher beta exposure. That's why the ongoing debate among analysts matters so much. Some are focused on near-term risks, highlighting macro uncertainty, policy transitions, and potential volatility in early 2026. Others emphasize structural changes, such as ETFs, institutional adoption, and evolving market cycles that could override short-term noise. Both perspectives can be valid at the same time. Real funds manage risk dynamically, protecting capital in the short term while maintaining exposure to longer-term upside. It's not contradiction, it's layered strategy. For XRP, this layered environment creates both challenges and opportunity. Price may remain choppy in the near term, especially with thin liquidity and headline-driven swings. But beneath that noise, the foundation appears to be strengthening. On-chain developments, expanding partnerships, and the steady march toward greater regulatory clarity continue to build the case for relevance beyond speculation. As we head into year-end, markets may remain quiet on the surface, but history suggests that these are often the moments that matter most for positioning ahead of the next major move, for positioning ahead of what could become a much more dynamic environment once liquidity and participation return. Looking specifically at the final days of 2025, the crypto market remains stuck in this familiar holding pattern. Holiday trading is thin, and every small move feels exaggerated because there simply isn't much volume to absorb orders. As of now, XRP continues to trade around the 1.88 to 190 range, slipping slightly on low activity, while Bitcoin holds near 88,000 and Ethereum hovers just under 3,000. It's classic year-end behavior. Many traders have stepped away, funds are wrapping up their books, and attention is shifting away from short-term price action. But beneath that surface-level calm, the institutional narrative around XRP keeps strengthening. Spot XRP ETFs have now surpassed $1 billion in cumulative net inflows since their launch, with some estimates pushing assets under management closer to $1.2 billion. Even more striking is the consistency of those flows. These funds have recorded positive inflows day after day, without the kind of outflows seen in Bitcoin and Ethereum ETFs over the same period. That tells us something important about demand. Institutions aren't chasing momentum here, they're steadily building exposure. As these ETFs accumulate XRP, hundreds of millions of tokens are effectively removed from active circulation. Exchange balances have been declining as a result, tightening the available supply. While that doesn't immediately translate into higher prices, it does alter the underlying market structure. When demand eventually increases, whether through renewed retail participation or additional institutional allocation, a tighter float can amplify price moves. This is why early ETF stages often feel underwhelming. The impact tends to show up later once conditions shift. Regulatory developments continue to add incremental support to this longer-term setup. The Digital Asset Parity Act proposal, which would exempt capital gains taxes on regulated stablecoin transactions under $200, is gaining attention as a practical step toward everyday crypto usage. By reducing friction for small payments, it encourages real-world adoption rather than pure speculation. Because stablecoin issuers typically back their tokens with U.S. Treasuries, the framework aligns with broader economic interest while promoting innovation. If this proposal gains momentum into 2026, it could meaningfully increase on-chain activity across the ecosystem. For networks like the XRP Ledger, designed for fast and efficient settlement, higher transaction volumes translate into stronger utility narratives. Combined with Ripple's expanding network of over 300 institutional partners and the rollout of features like native lending, XRP's role is evolving. It's no longer viewed solely as a bridge asset, but increasingly as institutional-grade infrastructure. On-chain data supports that shift. Whale holdings remain elevated, and reduced exchange balances suggest continued accumulation rather than distribution. The broader altcoin thesis remains intact as well. Despite lagging Bitcoin, metrics show altcoins at extreme oversold levels relative to BTC, similar to conditions seen near previous cycle bottoms. Potential rate cuts, improving liquidity conditions, and maturing ETF products could all act as catalysts for rotation once confidence returns. Analysts remain divided on timing, with some expecting turbulence in early 2026, and others anticipating a stronger breakout in the first half of the year. That split reflects reality. Markets are complex, and outcomes are rarely linear. What's clear is that quiet periods like this often precede meaningful moves. Thin. Liquidity amplifies short-term noise, but long-term trends continue to develop in the background. For XRP, consistent ETF demand, regulatory tailwinds, improving fundamentals, and signs of accumulation all suggest that patience may be rewarded. As we move through the final days of the year and into January, attention will shift back to inflows, narratives, and positioning. The pieces are quietly aligning, and while nothing is guaranteed, the setup heading into 2026 looks far more interesting than the sleepy charts might suggest.